tariffs. Well, the Trump administration is scheduled to impose a second round of 15% tariffs on roughly $160 billion of imports at the end of the year. But our next guest says he doubts those December tariffs will even happen. Joining us now from Philadelphia is Brandywine Global Portfolio Manager Jack McIntyre. Jack, thanks for joining us. Today's developments perhaps give some credence to what you're talking about, since there seems to be at least a little bit of rhetoric around wiggle room on the tariffs, although we don't know how much that is actually going to become reality at this point. So what do you think? Does this solidify your thinking?
I guess my view, well, it does, because we have the view that tariffs aren't going to get worse. And the reason I say that and why I don't think December are going to happen is because we've cut to the bone, meaning that, hey, this is, if we go down this path of increasing tariffs on the next round, it's going to have implications on the consumer. The consumer has not really felt a lot of the tariffs up to this point. That's going to change. It's going to hit consumer goods going into an election year. So Trump doesn't want that. And the idea that he put this out a couple of months, it gives us some room to negotiate. So, yeah, I don't think we're going to see that round, but we'll have to wait and see.
And part of the motivation for that we see consumer prices already headed up, but we also are starting to see consumers pulling back a bit on their spending, and that's what's been driving this economy. Is it too late to turn that around?
Yeah, that's a good point, because we've got this unique dichotomy right now where business sentiment has kind of rolled over, yet consumer sentiment is holding in there. And, there's two ways that's going to play out. Either consumer sentiment is going to stay high, consumers are going to sort of start to ramp up more purchases, and that's going to flow through to business sentiment, or we're going to see the opposite, the vicious cycle where business sector starts to kind of maybe cut back on employment, and that works its way into erosion of consumer confidence. But if that's the case, again, this administration, we are making the assumption that Trump wants to get reelected, and he needs a strong economy for that to happen. So he's going to have to pull some levers, to get a strong economy. And one of those, I think we need to see some progress on the U.S.-China trade front.
So, Jack, it certainly sounds like the tariff and trade war is not a clear and present danger for you and your portfolio team. When you sit in your investment committee meetings, what are your top 2 or 3 concerns, and what kind of shorter term moves are you making to address those?
So you're right. In some ways, I don't think it's a very complicated world. It's complex. But what I mean by that, what we have to figure out as investors is the direction of the U.S. economy and the Chinese economy, because they move the needle or really more determine global growth. Europe is a taker of growth. Japan is a taker of growth. So we spend a lot of time focusing on what are the growth metrics of the U.S. economy and China. And so, with China, again, we are making the assumption that they're going to go down the path or continue down the path of doing more stimulus, monetary, fiscal, try and stabilize their growth in their economy. And then, but again, on the U.S., we're not, firing on all cylinders. Yeah, the consumer's doing well, but it goes back to, making the assumption that Trump wants to get reelected. So we've got to see, more progress on U.S.-China trade. But one of the things that, we're focusing on is the fact that global inflation is very low. We are seeing a big wave of global monetary stimulus, let alone what the ECB did today. But we are seeing a wave of other countries cut rates because they can. And I think that actually should help the global economy get a little bit of traction.
One of the things that I know you and your team are examining is also the possibility that we would get some sort of more direct U.S. currency intervention. At this stage, though, I think you put the odds pretty low of that happening. Is that right?
Yeah, I'd say it's still a fat tail event. Interestingly, with the ECB's move today, maybe, we took a little step towards that, although the euro was actually higher on the day last time I checked. But right, and the reason I wouldn't ignore it is because hey, it depends on the Fed. If the Fed sort of takes their time, doesn't cut as much as the market expects, we know Trump's feeling regarding the Fed. We know Trump's feeling regarding a strong dollar. So it could be that things would have to get worse in the U.S. The odds of a recession would have to increase because it's a pretty dramatic policy tool. I kind of coined it sort of the nuclear option, because to go sort of down this path of unilateral FX intervention to weaken the dollar, and there could be some unintended consequences around that, is a major step. I don't think we're there yet, but if we are, if the yield curve is right and we are going into a recession in the U.S., then I would not rule out Trump taking a proactive approach and trying to weaken the U.S. dollar, because we know the dollar strength is having a negative effect on the U.S. corporate sector.
All right, Jack, thank you. Jack McIntyre, Brandywine Global Portfolio Manager.